Greetings, my name is Arjun Brar, and I hope that you all have had your coffee today because we are ready for the presentation. Firstly, I would like to introduce my team members, Ajay Sadhanala, Arivardhan Singh, and Aditya Tiwari. Our recommendation is to buy Southern Company stock with a 1-year target price of $84.18. Southern Company has capabilities across 50 states, serves more than 9 million customers, employs more than 27,000 people, and has a generation capacity of 43,000 megawatts. ESG reporting has become a standard practice across utilities, and Southern Company is proud to be at the forefront of this movement by actively diversifying their energy generation portfolio and disclosing data to leading ESG reporters like MSCI, Sustainalytics, and CDP. The company's goal of reaching net zero GHG emissions by the year 2050 never seemed closer. Southern Company has already reduced 91% of their existing coal units and has achieved a 52% reduction in overall GHG emissions for the year 2020. Southern Company has been including more people of color and women, not only in the workforce, but also in the board of directors. Southern Company also appointed a new CEO, Chris Womack, to ensure further growth of the company.
In terms of market positioning, Southern Company operates in a highly regulated market. Southern Company distinguishes itself by focusing strategically on renewable energy and nuclear energy. The market entry barriers to the utility industry has a high barrier for new entrants because of the economies of scale. The utility industry also has a moderately competitive landscape because of already existing players, and the low buyer power allows the utility industry to set its own prices. Southern Company also has a diverse energy portfolio and a strong market presence with a loyal consumer base, and it has been expanding into renewable energy and new markets. A deep dive into Southern Company's finances reveals that it's a very robust financial entity. Its return on equity is 10.1% compared to the industry average of 5.9%, and its return on assets is 2.6%, which is among the market leaders, and compared to the industry average of negative 0.6%. Southern Company has also been giving annual dividends for the last 76 years with a 7-cent increase each year since 2002 with a CAGR of 3.5%. The Southern Company's total debt to capital ratio has seen a marginal increase since 2018, and its debt to equity ratio is 1.76, which is pretty standard in the utility industry and shows that the Southern Company can invest in large-scale projects such as the Vogtle 4, and the commencement of the Vogtle 4 in the second quarter of 2024, complemented by the Vogtle Unit 3's effective cost management, places Southern Company in a very effective position for further growth prospects. Its EBITDA has also seen an overall increase in the last 15 years, and in the next graph we can see that EBITDA is more than capable enough to cover for the interest expenses, as the ratio generally hovers between 4 and 5 for the last 6 years.
To reinforce the financials highlighted by my fellow colleague, I would like to add that the company has been generating stable operating cash flow. We have also observed a positive trend line in the cash flow, which means that there is a steady growth. In the following graph, we have also analyzed the ratio between the operating cash flow and the capital expenditures of the company. This graph further tells us that the capital expenditure requirements of the company are being majorly met by the cash flow generated by the company. Following this, we now dive into the valuation models used by us to calculate the intrinsic stock price of the intrinsic price of the stock. We have used 4 models here: free cash flow model, dividend model, old PE multiple model, and a comparable company model. The weighted average cost of capital is 5.6%, which includes a cost of equity of 6.7%. The short-term and long-term debt used is 4.5% and 5% respectively, adjusted to a 21% marginal tax rate. A 5% market risk premium has been used, and a 4% risk-free rate of return derived from the 10-year US Treasury yields has been used. Now, our free cash flow model further projects a 5-year outlook for the company establishing a target price of $80.99 as the base case. For the up case, we have a target price of $95.76, and for the down case, we have a target price of $67.26. We now dive into the dividend model used to calculate the price. Here, we have utilized the 3.5% dividend growth rate used for future dividend distributions. This has been analyzed from the financial analysis section as mentioned before. This sets the price target at $89.38 as the base case, which is further expanded into a range using sensitivity analysis, giving us a price range of $66.51 to $136.19. Now, from 2008 to 2023, CapEx and PE ratios have shown a slight correlation in the utility industry. For our stock, the correlation number is 0.38. What does this tell us? This tells us that CapEx slightly boosts the PE ratio. Now for earning per share of $2.80, the model targets the stock at $71.40. For cases where the earning per share is $1.80 and $3.80, the model targets the price at $44.10 and $100.70. Note that these are the projected earnings per share, and the expected earning per share is close to $3.80 or $4.10.
Moving on to comparable company evaluation. This is an industry standard to do the valuation model for Southern Company, and we have used its competitors to do this. We have taken Nextra, Duke Energy, Exelon, American Power, and so on for this valuation model. What we did is we took the EV by EBITDA and adjusted it for the cash and debt ratio of the company. And we got an intrinsic price value ranging from $5.1 to $143.5. Moving on to the complete valuation summary. Our team has took the industry standard methods to get to this conclusion. So we have taken FCF and given it a weightage of 15%, and for dividend model, we given a weightage of 35%. And moving on, we took own multiples and gave it a valuation of 35%, and for comparable, we gave it a weightage of 15%. In total, we gave the company a total intrinsic value of $84.18. And moving on to investment risk, we all know that financial stock market and every company has its own inherent risk. Southern Company is also no different. So Southern Company, the major operational risk is it generates its fuel through nuclear fuel. So we know it is always dangerous coming to disposal of that energy and storage of that energy. So there is always risk associated with it. And moving on, we know that Federal Reserve fluctuates the interest rates year over year, which can impact the revenue of the company. Moving on to the supply chain risk, COVID has taught us enough that anything can happen at any given point of time. We all know the example of Evergreen blocking a trade route, which caused major disruption in the supply chain. For suppose we take Southern Company and a fuel cargo ship is carrying fuel from different country to homeland United States, and something happens in the major trade route, it will affect the entire power generation over here. So that could be a real risk. Moving on to finance and economic market risk. So always the global fuel prices fluctuate. The reason why we have seen an increase in revenue and decrease in revenue for Southern Company. So any such kind of things can impact the total revenue of Southern Company because of the gas prices, as Southern Company almost sells 50% of its gas. Moving on to global events. Again, COVID, we are not new to that. So any kind of global pandemics or any kind of war or anything like Russia, Ukraine can impact the fuel prices across the world. So we know that those kind of impacts is medium, but the probability of such things happening is pretty low. Moving on to the conclusion. So our team has deep dived into Southern Company's complete balance sheets, investment statements, summary reports, and everything, and we came to the conclusion that Southern Company is a good buy. Why? Because the health of the company is very good, the market position is among the leaders, and the green shift, we always want to continue to live in this planet and be safe for our generation and the future generation. We want to make money, yes, but we need to be here to enjoy that. So we recommend a buy recommendation for Southern Company at a target price of $84.18 with an upside. Yesterday we have a closing price of $67.69. So this gives us an upside of 24.36%. And with that, we conclude our presentation. And thank you so much. And if you have any questions, you can please go ahead. Thank you.
Judges, you'll have 10 minutes to ask questions, and I'll let you know when we're at the last minute.
Thank you all for cycle.
Yeah.
And you also mentioned that you use 4 different valuation models.
Yes.
There are specific weightings you assign to
Yes.
each of the models. Can you walk us through how you decide on the weighting for each of the valuation models?
Yeah.
So our 4 models used were FCF, comparable company. These 2 models were given lesser weightage. Now, for comparable company, when we analyzed the model, we got a range from $5 to $140.
Yeah.
That is too of a variable range to get an estimate, an accurate estimate. But for FCF model, the previous years have shown a negative cash flow in the company. Our model, despite it projects a positive cash flow, we cannot say for certain because of the future capex requirements that the cash flow will be definitely positive. Because of this very reason, this model is not an accurate indicator for this stock. For dividend model, the company has been boasting of its dividend in all of its investment reports in the front page.
Yeah.
And for utilities, dividends is very important. So we have given it a very important weightage here, and we are left with the own multiple method, which is only based on the PE ratio and the earning per share ratio. And for that reason, we have given it a 35% weightage.
Thank you.
Just a question, I think in one of the earlier slides you said the return on equity was 10% versus 5% for peers. What peer group did you use for that?
Yes.
So the entire peer group used was the 257, the entire industry, which consists of 257 stocks.
Yeah.
All the 257. Compared to the market leaders, the top 8 and 10 companies, it's almost on par with them.
Yeah.
But if you take the whole industry as a total, it's above them.
So those are similar regulated utility companies?
Yeah.
Yes, sir.
Yes.
Okay, thank you.
One question I have is, you came up with a recommendation of $84,
Yes,
but
sir.
the current pricing is 69,
Yeah.
right? And also, in your conclusion analysis, the comparable company analysis also comes up around $60, 59.9. Yeah,
Yeah.
the same slide back there.
This one. Yeah.
Yes, this one, right? So, could you identify reason as to why the market is currently underpricing both the comparable companies and also the industry, while your intrinsic valuations are coming up higher?
So for comparable company, we literally took the entire range, like what worst can happen and what the best scenario. That's the reason why we only took the top 10 companies. So as you can see over here, we have taken the market leaders like Nextra Energy, Duke Energy, and American Electric Power. So when we compare the EV by EBITDA ratio with these companies, we got a broad range. So it is like $5.1 on the low end. We got this range by adjusting the dividend and everything. So yeah, this is math and yeah.
And also I would like to add that the market has been underpricing the stock because of its debt. Right now it has capex requirements which it's been using for infrastructural purposes. It needs this capex because as per our analysis, the company has started late when it comes to ESG, but it has been catching up. So it has started late compared to the market leaders, but due to the extra debt that it's been taking, which is covered by the cash flow, but it has been taking some debt, some extra amount is being left. So that is helping, that is placing the company at an underpriced value. But this can tell us that company will show a better growth after a few years.
And with the commencement of the Vogel Unit 4 in the second quarter of 2024, the growth prospects just keep on increasing.
Do you have the number comparing the debt to equity ratios of the company relative to the peers? I think it was 1.76. Yeah, do you know how does this compare to what it is for the comparable companies that you took?
So it's almost at the same level with the,
It's
it's almost on par. The market standard is 1.86.
So you talk about, and actually just answer a question about ROE. It seems like the ROE for this company is higher than most of its peers. Do you know what differentiates Southern Company from its peers? Why? How come they can achieve such an ROE?
Yes, sir. So the main reason is again the work till 4 and work till 3. Work till 3 released in last year and it has been operating exceptionally. So we think that the entire environmental impact is the key indicator, performance indicator, because a lot of the Gen Z which is going into workforce in the coming years, they are more environmentally conscious and they want to make sure like where they're getting their energy resources from. As we are over here using Southern Company's electricity in the state of Georgia, even the Southern Company is providing service to Kennesaw University. So utility market is one such place that everyone needs on a day-to-day basis. So we feel like those kind of factors are really impacting why Southern Company is outperforming its peers. And definitely the investment into newer nuclear fuels and all of those things are just boosting the entire company going forward.
I would like to add another point into this. With the commencement, like once all 4 units at plant Booked site are commercially operational, the generation capacity of that entire site will be 2,234 megawatts, which will be the largest generator of green and clean energy in the country.
Yeah, so it will be the leader in that, yes.
On page 20, you shared with us 4 areas of risks your team has identified. How do you think about incorporating this risk to your projection for the a bull case scenario and the bear case scenario?
Like again, for risks, I would say operational risk, there is definitely we can include like nuclear fuel prices in the country, but the production is only limited to 15% in the energy mix of the company. So it's not significant, but it's only the disposal and the storage of the nuclear fuel is what we're considering the risk. And coming to interest rates, we have seen like interest rates fluctuating, especially during the COVID year, like in 2020, it got to near 0. So companies took advantage of that situation during that time and took a lot of interest. So it's a dynamic marketplace as of now, and we feel like Southern Company stock, like their investment portfolio into expanding into newer projects and all of those things can only make things better.
Can you talk about long-term drivers for the company? What do you see as the most important drivers?
So the longest driver would be the Booked site, because it's going to be powering at least the south for the next 40 years, and it's going to be very green and clean energy, renewable sources, cheaper to, the initial investment is a lot, but cheaper in the long run.
How much was the overall investment versus the original projected cost?
Just a second.
You do not remember that right now.
Unfortunately, we cannot answer this question.
But we'll get back to you.
Yes, sir.
No problem.
Can you walk us through the debt of the company, and if you have any concern about the maturity of the debt, given that a lot of companies raise debt during a low interest rate environment, and then now we are in a very different environment?
So far, what we have discovered is the company is planning to take on more debt in order to expand more. But it depends on the interest rates. And we have news that interest rate might decrease in the near future. So the company is expected to take in more debt. However, the company's debt is on par with the industry standard, so that is a standard for the entire utility sector. Also, majority of the debt is a long-term debt for the company.
1 minute remaining, judges.
How long term is the debt?
It's close to 70%, no, 40%.
Yeah,
40% to the capital.
Capital, yeah. And the debt is usually around the tenure is around 20 years. So the company has enough capital and it generates enough revenue every year to pay off its interest. So yeah.
Can you pull up the income statement?
Yes, sir.
Yeah. Can you talk to us about what happened in 22 with the revenues going up so high?
Yes, sir, I can. So basically, again, when we talk about the fuel prices in the market, so literally we have seen like the gas prices increasing to about $4. Just a second, last slide. The last slide.
And we are at time.
Oh,
Wish we could
so
hurry.
because of the prices.
Thank you.